And now we will learn how to record purchasing a new property. You need 3 accounts in your chart of accounts to record a property purchase. The first one is a fixed asset, and it will hold the purchase cost of the house or building that you're buying. And you would put the name or designate a name for that particular location. The second account you need is also a fixed asset, and it should have the words capital improvements or something like property upgrades, and it should also name the specific house that you just purchased. Usually there's a mortgage on that house or building, so you have to create another account to hold the balance of that mortgage, and the type of account that holds the balance of the mortgage on the property you just purchased is a long-term liability, and you would also put the house's name with that. Now let's pretend we're buying a house on Milburn Avenue, and that's the name. So we're going to create a fixed asset for that house with that name. But if we buy the house and name it Milburn Avenue House, we should also put another fixed asset in the chart of accounts called capital improvements on the Milburn house. And of course, the name of the long-term liability that will reflect the balance of the mortgage will be mortgage on Milburn house. By the way, it is also important to note that before this video, you should have in your chart of accounts an account for the owner's investment in the company that buys, sells, and rents houses that you are managing or that you own. You should also have an owner's withdrawal account in the chart of accounts for the properties, for the company whose properties you're managing. Now, we already learned how to enter these accounts in the chart of accounts, so before I started this video, I have already put those accounts in the chart of accounts of the sample file that we are using. Now, there are 2 possibilities as far as buying this house. We could pay the old owner directly or through the company bank account. Paying directly means the money comes directly from the owner's pocket to the new owner, or directly from the bank for the mortgage to the new owner. But in our first example, we're going to pay through the company that you have established that buys, renovates, sells, and also rents property. So assuming you're doing your transactions through a company, this would be how you do it in our first example. Let's imagine on January 1 of 2018, Holden, the owner, invested $30,000 of his non-business money into the company bank account from his non-business savings. Now, probably he's doing this because this is going to go from the company to an old owner to buy a new house, and that'll be his down payment. But what he's doing in this example is putting the down payment in the company bank account first, which is very simple to do. And whenever you have a major purchase that's periodic, you should always make a journal entry. From the main menu, click Company, Make Journal Entry. Make General Journal Entry. And of course, making a general journal entry was covered in other video series, and you could always Google it, and it's easy and common sense. But right now I'm just going to show you how to put it in, and you don't really need any other prior knowledge when you do this. So if we take a look at the situation, January 18th, Holden invested $30,000 of non-business money into the company bank account from his non-business savings. Okay, well, if Holden invests $30,000 from non-business, that means he's invested in the company $30,000. So we go to the owner's equity and we have Holden's capital. And when the owner invests, first of all, by the way, you should put the date, and I believe the date that we're dealing with is January 1 of 2018. So we can just come back here. And of course, whenever the owner invests, it's the capital account and it goes on the credit side. Just remember, it goes on the credit side when the owner invests personal money into the company, and that money went into the company bank account. So QuickBooks knows the other $30,000 is going to balance out on the debit side, and we put it for cash in bank. Now when we click Save and Close, what this had just done is it increased Holden's capital by $30,000, and it increased the bank account by $30,000. If we double click and go to the bottom, we can see this general journal entry made the bank account go up by $30,000. Now, the next part of the little story is when the mortgage company puts $70,000 from the mortgage that the company is borrowing, and before they physically hand it to the old owner to buy the house, that mortgage that they borrow goes into the company bank account while they wait to give it to the old owner to buy the house. And that's a $70,000 mortgage. Well, in order to get your books and records to reflect the balance of the mortgage, you would click Company, make General Journal Entry, put the date that the money actually came into the bank account from the mortgage company, click directly under the word account, and then click the arrow. And of course, the bank account goes up, so we're going to put a debit of $70,000 because that's the money that came in from the mortgage company, and push tab until you get to the next line. And the credit of $70,000 is the mortgage. So this is Milburn House Mortgage. It's a long-term liability. And after I save this, you will see the balance of the mortgage show up on the trial balance, and the company bank account will have increased by the amount that's borrowed from the mortgage company. Save and close. And now we have Milburn House Mortgage, $70,000. So that's an account in your chart of accounts. And every month when you make a payment to decrease the principal, this account will go down, so it will always show you the balance of the mortgage at any given moment. And of course, the bank account is now holding the mortgage that is waiting to be paid to the old owner to buy the house. And it's also holding Holden's investment. So it's holding both of them because you're waiting to write a big fat check to the previous owner. Now on January 3rd, you do write a check for $100,000 to the old owner from the company bank account to actually purchase the Milburn Avenue house. And we know it's got to be $100,000 because Holden invested $30,000 to make the down payment, and $70,000 came from the mortgage company. So this is very simple. You can open up the check window. For those of you who don't know, it's banking, write a check. The money is coming from the company bank account, and it's going to the fixed asset Milburn House purchase cost. So the bank account is where the money's coming from. That comes from the top of the window, and Milburn House purchase cost is at the bottom. And the amount that's decreasing the bank account, which is the amount you're paying for the house, is $100,000. Let's make sure that, yep, that's $100,000. So after I save this, the Milburn House purchase cost will show up on your trial balance as $100,000 and will stay there until you sell the house. Save and close. You can see the bank account has decreased by $100,000, and you can see Milburn House purchase cost showed up in the trial balance for the first time as $100,000. What if the money came from Holden's personal account directly to the previous owner? And what if the mortgage company paid the previous owner directly? Well, let's take a look at an example in that case. On January 4th, Holden gave $40,000 of non-business personal money to the old owner of the Chauncey Street house as part of the purchase price. Now again, we're imagining that I already put the accounts in the chart of accounts before I made the video in order to save time. Again, we will make a journal entry, company, make general journal entry. And of course the date was January 4th, so let's make sure we put January 4th. Now, even though Holden did not put the money in the company bank account, he did spend for his personal funds for a house that the company owns, and that was towards the purchase cost of the house. So in that case, it would be Holden's capital, and it would be credit the amount that he took from his personal funds and bought something that will be in the name of the company, so his capital investment should increase. And of course, because it was for the purchase cost of the Chauncey house, you choose Chauncey house purchase cost. Then click Save and Close, or Save and New. Now, on the next event, January 5th, the mortgage company gave $170,000 to the old owner of Chauncey house, and the mortgage is in the name of you or the company. So in other words, you borrowed a mortgage, but the money from the mortgage did not first go into the company bank account so you can write a check. The money went directly from the mortgage company to the old owner for the purchase of the house. So the way to do that is another journal entry on the day that it happened. And of course, the mortgage here's the long-term liability. The mortgage on Chauncey Street starts off as a credit balance of the amount that the mortgage company gave the old owner, $170,000. And of course, the debit in that case would be the purchase cost of the Chauncey house. So now when we click Save and Close, you can see the trial balance shows the Chauncey house purchase cost was a total of $210,000. Say, why is it $210,000? When you double click, you see on January 4th, the owner gave the money directly to the old owner, $40,000, and that was his capital that he invested. And on January 5th, the mortgage company, because I'll have to make the split a little wider, the mortgage company gave the old owner $170,000 to buy the house. So the total you paid was $210,000, and that's why purchase cost for the Chauncey house shows up as $210,000. You'll probably also notice that the Chauncey Street mortgage showed up in the amount of the actual balance. And you'll also notice that Holden's capital increased to $70,000 from the amount that he invested. And those are the two possible ways that owners of rental property or people who flip houses can buy the house.